And I'm speaking from the perspective of an accountant, both the internal accountant, the CFO, and the accounting staff, as well as potentially the auditor. And we're going to cover a few things related to financial statements, then some issues related to internal controls, because that is one of the key factors that companies will have to prepare for, and some common areas of comments that the SEC gives when they do review a filing. And lastly, just a little bit about what the auditor's role is. So you've heard a little bit from my previous speakers about the IPO market itself. And you've heard the IPO market in some years was quite good, in some years was not as good, and in the current year didn't start out great, but now is going fairly strong right now and looking to end the year quite strong. So what does that mean? If you're from the accounting perspective and involved in the preparation of financial statements and involved in the preparation and making sure the internal controls for a company are strong, you don't want to be the holdup in the deal. You want to make sure that whenever the investment bankers come and say, this is the right time for the market, this is the time to file, this is the time for us to go effective, that the financial statements are ready to go, that the document is clean, that it's been through appropriate levels of review, it's been audited under PCAOB audit standards. All those types of things need to happen. So our objective, really, as accountants, internal, external, and in many cases you may need some assistance with this, some consultants and others, is not to slow the deal down. So that is really our objective in all of this. And to do that, though, there's some number of considerations that need to be done early in the planning phase, because that's where some of the most key decisions are made about the financial statements themselves. So what are some of those key considerations? And when I'm talking about financial statements for an IPO, it doesn't matter really whether you're doing a traditional IPO or whether you're the operating company in what's called a de-SPAC transaction. So if you have a SPAC and you're the company that might be acquired, the financial statement requirements are not dramatically different. But some of the decisions to determine which financial statements are a little bit different if it is a de-SPAC transaction or a traditional IPO. The first and probably most important consideration is whether your company can qualify as a foreign private issuer. And that is a legal determination, and my colleague spoke about that, but that is something that you want to understand very early in the process, because that determines not only the form of the filing, whether it's an F1 or an S1, or if it's a de-SPAC, an F4 versus an F4, but it determines whether you have the option under the basis of accounting to use IFRS or whether you are forced to use US GAAP. And that is very important because in many jurisdictions outside the US GAAP is not commonly taught in universities, commonly used in practice. So if you're able to use IFRS, that is often a significant benefit in terms of the timing of preparing the financial statements, auditing the financial statements, and having the ability to then move forward. We mentioned earlier that the FPIs may be changing in the future. It was a concept release that came out from the SEC. It is not proposed rulemaking. There is a bit of time still before that could come into play, if it ever does. The comments that I saw to date were generally focused on not changing the overall definition of a foreign private issuer, and a lot of the comments were focused on that since the Commission allowed IFRS, that most foreign private issuers take advantage of that accommodation and use IFRS, and that regardless of any change that might be made in the definition, keeping IFRS as an available option was a strong consideration there. Now, in a SPAC transaction, if the SPAC is a domestic company, then you are forced to be a domestic filer. You don't have a choice. Likewise, in some of the transactions, if you create a U.S. holding company, then that means that you are a domestic company and you would have to file U.S. GAAP. So that's why I'm saying this is important to understand with everybody in the room what the structure is going to look like, because that's going to derive what your financial statements are likely to be. Within the filings of the types of companies, there are some categories. Most every IPO, that at least that I've seen, and most of the ones coming from this part of the world, will qualify as an emerging growth company. And essentially the biggest threshold for an emerging growth company in the IPO process is that their revenues are less than $1 billion US. So generally speaking, most companies going public will fit that criteria. An emerging growth company also has some advantages because they only need 2 years worth of audited financial statements instead of 3 in a filing. So again, that can, if you have not had an audit previously, and particularly because most companies would not have had an audit performed under PCAOB audit standards, that means that it's 1 less year of work that the auditors need to do, 1 less year of work that the company internal accountants need to do, and so therefore it can move the process on a lot quicker. Another thing to consider is that in certain circumstances, financial filings need to include not only the company or the proposed registrant's financial statements, but there may be other companies that also need to be included in the F1, S1 financial registration statement. If the company has done a significant transaction, they've acquired another company, and I'm not going to get into the rules on significance because they're fairly complicated, but if there has been a substantive acquisition of another company within 2 years, sometimes it's a year, again, depending on significance, then you may need to include that set of financial statements, audited financial statements as well. Likewise, if the company has a significant equity method investment in another company, that set of financial statements might need to be included in your filing. And in some cases, particularly if you're creating a new holdco, there may need to be separate parent company audited financial statements as well. Usually those are fairly straightforward, easy to put together, because usually the holdcos are capitalized on a very nominal basis, but sometimes you need those. And what you want to know is what you need, again, before you get into the process. You don't want to get to having the first set of comments come back from the SEC and they say, oh, you need financial statements of this company, and you hadn't prepared for that, and then that could delay the whole thing 2, 3, 4 months or however long until you can get that. So again, just thinking about all of those things up front, it does help make sure that when everyone's ready to go, the financial statements are ready to go. So what is required in the financial statements? As I said, if you are a foreign private issuer, you do have some choices that need to be made. The first is you can file financial statements as long as you can make the assertion under IFRS that it is IFRS as issued by the IASB. Now, I understand that Korean IFRS is very similar to IFRS, and the statements that I have seen for Korean public companies, the majority of them are IFRS that qualifies foreign private issuers, so I don't believe it's very difficult to say that Korean IFRS or IFRS is issued by the IASB. The SEC is just particular about there not being jurisdictional aspects of IFRS when they allowed it. You can always choose to do US GAAP. The SEC is never going to object if you want to use US GAAP, but it is generally not as easy to maintain because you're often then maintaining 2 sets of financial statements, 2 sets of underlying accounts, because you probably need local accounts for your purposes here. You can also do local GAAP reconciled to US GAAP, but again, since Korean IFRS is very close to IFRS, you probably would never make that choice. I very rarely see anyone choose the local GAAP reconciled to IFRS for ongoing reporting. Occasionally you'll see that for an acquired company that might have to be in the filing, but not for the registrant itself. So, as I said, the ones in Korea that I have seen generally used IFRS. One of them didn't qualify as a foreign private issuer, so they weren't permitted to use IFRS. But regardless of the accounting, the auditing has to be done under PCAOB audit standards. So regardless of whether the company has previously been audited or not previously been audited, it is likely that there is additional audit work that will need to be done, because primarily it was done under local standards, international standards on auditing, Korean auditing standards, but the PCAOB has some very specific requirements in their audit standards, and in many cases then they would actually have to, we say uplift, whatever, but there is some additional audit work, oftentimes some additional documentation that needs to happen. So if you have audited financial statements, don't assume, oh, well, I don't have to worry about that, I'm completely done. They can just take that and put it into a public offering. That is not always the case. There's also some other considerations that the auditors need to think about and the companies need to think about at this point in time. The audit firm must be registered with the PCAOB. There's just no exceptions to that, whether it's in an IPO or not. Now, I say there's no exceptions. The acquired company financial statements and equity method investees, it is possible those don't have to be a registered firm, but the company itself, the registrant, must have a PCAOB registered firm. There are also stricter independence rules with the PCAOB and the SEC than maybe in certain in underlying other auditing standards, and so you need to make sure that there's no potential independence issues in the historical financial statements. I mean, some things that are permitted, even under US audit standards, it's permitted to assist in drafting footnotes, as an example. That would be an independence violation under PCAOB rules, and had you done that in the historical financial statements, you would not be considered independent, so you'd actually have to get a new auditor to come in and re-audit that. Again, something you want to know well in advance, not up at the last minute here. Unlike in certain jurisdictions, in an IPO, for example, I know in Hong Kong, the audit firm does not need to be a US firm, and very frequently it is not. So any firm that is registered with the PCAOB can issue an opinion on audited financial statements in a US filing. The only thing is the individual partner has to be licensed in their own jurisdiction. They do not need to be a US CPA either. So there is some actual leeway in that. So you do very frequently see non-US firms signing opinions in registration statements and on an ongoing basis. So again, the financial statements requirements, I think were covered a little bit here. I just want to note a couple things here. One, EGC is the emerging growth company that I mentioned. The SRC there is a smaller reporting company. That is a classification of companies, but only if they use domestic forms and use US GAAP. So you don't see very many foreign private issuers that choose SRC status, but occasionally I've seen companies do it because the rules, not necessarily in an IPO, but because the rules in the follow-on of how quickly you need to include the auditor's attestation on your internal controls is different if you're a smaller reporting company. So I have seen companies choose to do that, but generally not. The age of financial statements was mentioned briefly. So generally in a filing, the financial statements must be current in that they meet the age of financial statements when they're filed for the SEC to review them, and then they must meet the age of financial statement requirements when the company goes effective. And when you go effective, it's actually a process that the SEC, and until very recently, they were manually written as effectiveness notices. Now they're electronic, like everything else. But when they actually declare the company effective, and that's, we kind of talked about the process a little bit, but when they've cleared all the comments, the company requests effectiveness, and then the SEC permits them to go effective. Usually that happens, in an IPO world simultaneously with the deal being sold as well, and the underwriter's agreement being signed and things like that. But what I was saying on the age of financial statements, so you have annual financial statements that can be no older than 9 months in a document without having to put interim financial statements in there. If you are a foreign private issuer, typically you are going to use 6-month accounts. You're not required to do quarterly financial reporting if you're a foreign private issuer. If you're a domestic registrant, you do. Now, sometimes investment bankers, underwriters want quarterly information, particularly if you're in the third quarter and you're after that, because to get more current information, if it's, if the company has a good trend, they may want to show that because it'll help potentially market the company, but you're only required to have interim accounts through 6 months. Now, there is a quirk, and that was mentioned earlier, with foreign private issuers in that, in theory, when they go effective, the financial statements can't be any older than 12 months. So if you were a calendar year-end company and you went effective in January, in theory, you have to have that most recent year's audited financial statements. Now, in practice, no one does that because you can't, and that's the dispensation that was mentioned earlier that you need to get from the staff to be able to use those, and usually you can get that for sometimes the full 90 days, sometimes a little less, it just depends. But generally speaking, you want to have financial statements that are no more than 3 months after year end, and interim financial statements have to be anytime you get past 9 months, you have to have those in there. And I say that because, again, you think, okay, well, I've got the audited financial statements, I'm done, but then depending on how long the review process takes, you either have to be prepared to get the next year's audited financials, or you also have to be prepared to have the interim financial statements. The interim financial statements are not audited, but they are reviewed by your accountant. So they still go through the process. They still have to have footnotes, but they're abbreviated footnotes. They don't have to be the full footnotes that you'd otherwise have. As we said, the 2 years, just do remember that after a company goes public as a foreign private issuer, then they have to report the third year. So it's only the accommodation in the registration statement that allows you 2 years. After that, you have 3 years P&L, 3 years of statement of changes and cash flows. So it's just, again, a formatting to keep it. At that point in time, it's not additional cost because you already have it audited. You already had it in your registration statement. So let's talk a minute about internal controls over financial reporting, an area that everybody loves to talk about, whether you call it SOX reporting, whether you call it internal control reporting, ICFR reporting. It is something that all U.S. public companies are required to do after they have gone public. The registration statement itself does not need to contain either management's attestation on internal controls or the auditor's attestation on internal controls. However, in my general theme of be prepared here, you do want to have considered the controls and be ready to be in a position to opine on your controls in the future, because again, you don't want to go public and have the first time management has to report on internal controls, report a material weakness. It is, and that you have not told the market about in your registration statement. You don't want to be in that position. So you want to have the controls in place. Now, as I said, there isn't a requirement for either management or the auditors to include an ICFR opinion in the registration statement, but if in the course of doing the audit or in the course of the company preparing the financial statements, they determine that they have a material weakness, that does have to be disclosed. You can't ignore it if you know about it, but you don't have to have an opinion on it. Management, again, would be required to include their assessment of internal controls in their second annual filing. So the first annual filing, whether it be a 20F or a 10K, again, a foreign private issuer, a 20F, does not need to include management's attestation on internal controls or the auditors. The first one after that, so in essence the second, does need to include management's attestation, and whether the auditor's attestation is required depends on whether the company still qualifies as an emerging growth company or whether they have lost that status. For the most part, companies can retain their emerging growth company status for 5 years, no longer than 5 years, but the maximum is 5 years. However, if they meet certain thresholds, then they lose that emerging growth company status. Either if their revenue goes over, it's a little over $1 billion because it's inflation adjusted, so it's $1 billion something, but somewhere in that range. Or they become a large accelerated filer, which is another category that the SEC looks at, and the accelerated filer and large accelerated filer status for a foreign private issuer is based on your market capitalization, and it's your worldwide market capitalization. Again, usually that is something you want your counsel to assist in determining what exactly falls into that determination of worldwide market cap. But if you get over 700 million in market capitalization, then you will lose your emerging growth company status because you become a large accelerated filer, in which case you would then have to have your auditor to include a report on internal controls. But even if you go public, wildly successful, 700 plus million, the first year nobody has to have the internal control report in there. So, you know, again, that's why I'm saying preparation is really important, because that is a time-consuming process. Depending on how well your controls are currently documented will determine how much work you have to do. I would say that the majority of companies that I see when they have to report internal controls for the first time use a consultant to assist them. Consultants all across the board, different types, sizes, etc. But I've seen pretty much everybody uses a consultant to help them at least get the initial controls well documented. And again, the control process itself is a risk-based approach. So the more significant the control is, the more documentation and formality needs to be around that control. So for example, if you have a control that someone is reviewing the percentage of completion in a revenue calculation, or a goodwill and or intangible asset impairment calculation, those are going to require a lot more documentation than perhaps the controls over bank reconciliations, which again, don't require necessarily as much thought and judgment into what that control is involved. Okay, some areas that the SEC staff might focus on when they are reviewing financial statements. So when you file a registration statement, it has been said, the SEC staff will review it. They look at every IPO document, and they have 30 days to get comments back to you. And unlike their periodic reviews, which they will do for companies on an ongoing basis, for an IPO, pretty much they review it cover to cover. They will look at kind of every disclosure, every page of that filing, and you're subject to getting comments on every page of that filing. Again, from an accountant's perspective, our objective, no comments, or very, very few comments that are easy to fix. And so to do that, you want to think about, well, what are some of the most common areas where we do see comments? Where does the staff tend to focus when they're reviewing a document? So these are some of the kind of key areas, and a lot of these go across industries. They are accounting framework agnostic. Doesn't matter whether US GAAP, IFRS, they're still going to look at these. So a couple of things that are important. If you have issued any form of equity prior to going public, the SEC staff will be very interested in how that equity was priced compared to your IPO price. It's a concept called cheap stock. In other words, you cannot give insiders stock at a price a lot less than what the IPO price is unless you're going to book compensation expense for that. And in most cases, companies are not booking compensation expense. They're giving options at market, whatever that is for an unlisted company. And then if it's dramatically different, the staff will want to understand, well, what happened in that intervening period. It might be that very specific things did happen in that intervening period, but you have to be able to prove that. Likewise, if you are doing a de-SPAC transaction, there are a number of accounting issues related to the warrants that the SPAC shareholders will often have, and sometimes it's the insiders that have them, and the classification as to whether they are equity or debt. That is also the case with companies that have received private equity funding, because oftentimes that private equity funding will have different terms to it. It can be convertible preferred, it could be convertible debt, it could have debt and warrants, stock and warrants. All of those tend to add complexity to the financial statements and are areas, again, that you want to make sure you have addressed very early in the process. And whether you, again, need a consultant to assist that sees a lot of these type transactions, because they do have complexity. The SEC staff will have their views on how these should be accounted for. Again, it doesn't matter whether it's IFRS or US GAAP. In some cases, their views, again, are accounting agnostic. So you just want to be aware that those are some of the key areas. Revenue recognition, if you have revenue, a lot of IPO companies may be in the, particularly biopharma type companies, may be in the pre-revenue stage still, but if you have revenues, that is an area the staff will focus on, because it's an area typically investors will also focus on if you have revenues, because that's what you're generally buying into. So particularly very clear on the disclosures related to the revenues, what triggers revenue, is it over time, point in time, the various aspects of IFRS 15 or ASC 606. Fair value measurements, the same thing. I hit on those with some of the complex financial instruments. But again, the valuation of those and what drives that value. What are the key inputs into the valuation model? Is it the discount rate? Is it the growth rate? Whatever it is, that should be very clear from someone looking at your financial statements. Segments is like the ever-present SEC comment, and it is very particularly important in an IPO document, because when you're thinking about a company, the segments is dividing that company up into the different ways of reviewing it. And it depends on how management looks at the company. Sometimes that's geographical, sometimes it's product line based, sometimes it's based on different companies. There's a lot of different ways you can look at a company, but the SEC staff will generally be highly skeptical of companies that say they are in one segment, and that they seem to have in their discussions, either in the front part of the document or otherwise, it implies that perhaps there's more than one business line, and then the company, how is management compensated? Well, they're compensated for this, and that could lead to potentially being a different segment there. So that's something that oftentimes the investment bankers and lawyers are very heavily involved with early in the process to understand how you're going to describe the business in the rest of the document, because this is kind of for the financial statements, but that carries forward into your S1 or F1 registration statement of how you're describing the business. I already mentioned liability or equity classification for financial instruments. The last one, the use of non-GAAP metrics or non-IFRS metrics, depending on if you want to be generic with GAAP or IFRS, is absolutely another area that the staff always looks at. Typically, and I will explain why not always now, typically non-GAAP metrics are not included in the financial statements, but they are outside the financial statements. And the staff will ask a number of questions. Often they're in the management's discussion and analysis section. So that is often where you see these questions come up about non-GAAP metrics. The interesting thing that is just going to start coming into play in the near-ish future is that IFRS has recently issued IFRS 18, which is, the International Accounting Standards Board has recently issued IFRS 18, which is the basis of presentation. And in it, it requires management performance metrics, or MPMs, to be included in the audited financial statements. These are, by definition, non-GAAP, non-IFRS metrics. So it'll be interesting to see how the convergence of the new IFRS standard and the SEC's rules and guidelines ultimately come together and what they permit to be included in the financial statements. Since IFRS requires the inclusion, the SEC will allow it. It's just, again, like how much they will question about whether it meets the definition of a management performance metric, et cetera, or whether it looks like companies are trying to get in some other types of non-GAAP metrics that maybe don't meet the MPM requirements. So, but it is, that in and of itself is a key issue. And also, as I said, it'll be interesting to see how the two sort of come together there. They have objected to the FASB's guidance on segments, including a second non-GAAP metric. So we'll see what they do. So kind of the last area just to talk a minute about is the auditor's role themselves. I've talked, a lot of the financial statement information is kind of important from all accountants' perspective. The auditor's role, as I've kind of alluded to, I mean, absolutely critical. You cannot go forward without an assigned audit opinion. And it has to be a clean opinion, with the exception of going concern, which you see sometimes even in IPO documents in biotechs and startups. But for the most part, it cannot be any sort of a qualified audit opinion. It has to be a clean opinion, which again, getting back to some of the preparation, you know, if you're a manufacturing company and you have inventory and you've never been audited, then you might have to have a period of time for the inventory audit procedures to be performed, things like that. So it does have to be a clean opinion. There's essentially no exceptions that the SEC will accept, as I said, except for going concern. And you also need to think about, from an auditor's perspective, I mentioned in some cases an auditor might not have been independent, so you might have a different auditor. If you have more than one auditor involved in the registration statement for the 2 years, or if it doesn't qualify, the 3 years, then you need to have opinions from both of them because all the years need to be covered. And it's just coordination exercise in making sure everybody's on the same page and everybody's doing the timely, getting their opinions ready and they're ready to issue them, et cetera. But essentially our main role is to make sure that the financial statements are compliant with SEC criteria. They comply with the underlying accounting framework. They're done on a timely basis, and that, you know, we don't hold anything up in the whole process. We're ready to issue, unless it's appropriate to hold it up. I'll put it that way. We try not to, but if something's not done or disclosures aren't made, obviously we can't issue an opinion. We don't draft financial statements. We cannot respond to the SEC on the comments that they give. We can help the company, but from an independence perspective, we actually can't do that. The other fairly important thing that we do is that we ultimately, as part of the process of going public, we will need to issue a comfort letter to the investment bankers. So as part of their due diligence work, they will ask for a comfort letter from the auditors. And it's a very particular form of a letter. It takes the registration statement, circles certain numbers. We provide comfort or tick marks on those particular numbers. And the importance of that is that, again, it's a time-consuming exercise on both our part and management's part. They have to get us all the support so that we can then tick mark the individual numbers if we don't have it in our audit support. So again, why that process needs to happen as early, at least from a draft perspective, that the underwriters get a draft of our letter so they know what we're going to say, so that we get a draft of what they're going to want comfort on so we can say what we can and can't comfort. It's just important to get that done on a very timely basis there. Oops, let me go back. Okay, sorry. There we go. Appendix. I just wanted to highlight a few things I'm not going to cover in detail. There is the definition of a foreign private issuer legal, but I know that was covered. I have that in there as well. I also have the definition of an emerging growth company, which is a little more quantitative. We can usually figure that out, but it's always nice to make sure everyone agrees onto it. I also have in here, just kind of quickly, a draft timeline. Again, a lot of things can determine whether that timeline moves as quickly as planned. Most importantly is how ready is the company. And that readiness can be both from a financial statement perspective, it can be from having their corporate documents in place and how early they've worked with their counsel to make sure they have their corporate documents all in place. It can be, do they have the right people in place? Because sometimes who they have in the company might not be the right people needed in a public company that has to report on a much more timely basis. They may need to add people to their accounting staff, or they may need to work with outside counsel or outside advisors to make sure that they have all that in place. But again, just sort of a general time frame there. And then lastly, just a little bit about BDO that you can all read at your leisure. Both BDO worldwide, BDO here in Korea, and BDO in the US. So with that, I want to thank everyone, and I will turn it over to the next speaker.